Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are back with another Ask an Advisor episode. We don't technically have a financial advisor in the studio with us today, but we have someone who I'm sure often plays the role as a pseudo advisor in their own way, because for most Australians, the first financial professional we speak to these days isn't a financial advisor. It's a mortgage broker. And in the studio with us today is Bryce and my own mortgage broker.
Yes.
Not only, you've broked for a lot of other people as well.
Yeah, that's true.
But the mortgage broker that helped us out and the first financial professional I spoke to, Chris Bates. Welcome to the show.
Thanks so much. You actually make a really good point there to start us on people going to mortgage brokers first, because I actually was an advisor prior to becoming a mortgage broker. And this is one of my frustrations when I was on that side of the fence. Is I was working with a lot of older clients, and I said, you know what, getting a little bit over of working with the pre-retiree and the retiree. I want to help people make decisions that are going to compound for their future. And I said, well, what do young people really want to talk about? What's actually property, and who are they going to talk to? Oh, it's mortgage brokers. Maybe I need to head into that direction. It was one of the motivations for me to become a mortgage broker, because younger people's, their biggest challenge, opportunity, the biggest thing they're worried about, the biggest motivator was property. And mortgage brokers are having those conversations.
Yeah.
Yes.
And I think, if you think about what you need to do to maximize your mortgage, it's like get some of those basic financial things done. Get out of debt, get your cash flow sorted. And so, whilst a mortgage broker can't give financial advice, personal financial advice, they certainly can help you get set up without the high cost.
Yes.
Anyway, we'll get into all of
We'll
that.
get into that. So just a reminder, so Chris is co-founder and mortgage broker of Flint. And just like any advisor that we bring on the show, if you would like us to put you in touch with Chris, head to equitymates.com/advice, and there'll be a form there, and we'll connect you with him and the team. Because we certainly got a lot of value out of Chris and the work that your team did. So yeah, thank you for that. Now, to kick off, we both were clients of yours.
Yes.
So we must ask, who was the better client?
What a great client is, it's, putting you to a side, is someone that has a bit of critical thinking, is willing to listen. So a frustrating thing as an advisor is someone walks in and is a bit of a know-it-all, right? And they just want to validate their ideas and facilitate what they want to do. And a true advisor doesn't do that. A true advisor stops them and asks them a difficult question, challenges their thinking, really debates a point which might seem minor to the client, but the advisor knows it's something that's actually really worthwhile talking it through. And I would say you both listened to that. I remember there was a lot of debates around how we structure the loan, whether we go to a max and then we use an offset account. There was a lot of bit challenging around the type of property that you were looking to buy and the flaws in the type of properties that you were looking at. So even though you're emotionally charged and you're heading down a different direction, you're willing to listen to someone's advice. And I think if that would be my advice to any person getting advice, is if you're going to go and pay for it and go into a trusted advisor, don't just go in there and then try to prove them wrong and validate your ideas, because you're not listening. And so I'm not going to pin one versus the other. But that would be, I would say that you both approached it the right way, and you both listened and you challenged. And then when you came back with more questions. And so I remember I could see your thinking progress over time. And I think when, what good advice does is it stands the test of time. And so often when we give advice, whether it's around a type of property and what not to buy, or whether it's the structure of the loan, the client doesn't really know the benefit yet. It's usually 2, 3, 4 years down the line, and they go, oh, that was actually a really good decision on reflection. I assume maybe now you're starting to see the benefits of those, because it's so emotional at the time, you actually don't see the benefit right away.
One of the, I guess, biggest misconceptions I had about going to a broker, and particularly you guys, was that I thought it was just you guys would help me find the best bank and the best loan. And everything that came with that over the journey, the conversations, the strategy, everything that you kind of helped us through was an added bonus that I wasn't expecting, but provided so much value, because what we thought we were going to buy at the start and what we ended up getting and structuring the loan and all of that sort of stuff was completely different. So it was, and all for essentially not free, but with no upfront cost. And
I think we have got a bit of an added benefit in that we came to broking from an advice background. So that's my heart, my soul. It's where my passion is, right? And, and there's only one way to what's best practice in my mind, right? So, we've got to live up to that. I think a lot of brokers, unfortunately, haven't come into broking from that background. So it's not that they don't want to do the right thing. It's just they haven't really got that knowledge and thinking to think, actually, structurally, my role is much more than just facilitating and providing a loan and a bank. But I think the good thing about the broking industry is moving more and more into a trusted advisor profession. It's the ticket to the game is much higher, right? And so they have to skill themselves up, because I do think the quality of mortgage brokers is getting better and better. But I do think it's providing a loan, everything like that, but it's really the structure of your loan. It's how does this fit into your longer term plan? I think if you're in front of a mortgage broker who's asking you those type of questions and helping you think through your longer term plan, that's the right type of broker, rather than when you're in with a broker and they're talking around, hey, we're going to go with this bank and this is the rate. I think you just probably, can probably up their game a little bit.
I remember 2 instances where I sent you 2 properties that we were super interested in and almost put in some offers, and I think it came through the team and back to you, and you called us straight away being like, hold your horses. What are you doing? What are you doing? So
hold on, how specific can we tell us?
Well, yeah, one was down in, it was really early in the journey. We were emotionally like, let's go.
Yeah.
I was going to say, I feel like I didn't have such an emotional journey. But I feel like maybe that
we were probably 12 months was ours from really taking it seriously, with sitting down with Chris for the first call to buying the place was 12 months, I reckon, maybe a little bit more. And so early on in the piece, kind of had the budget in mind, didn't quite have the loan structure that we went with, but it was like a dual commercial residential down in the depths of Surrey Hills. I don't know if you remember this, but
I do now.
2 stories next to 3 terraces that had been empty for 20 years and owned by some guy in Hong Kong that was up for development, but hadn't been through development for like 20 years as well, or whatever it was. And we were like, this is awesome, big size, blah, blah, blah. And Chris has just called and said, guys, what the hell are you doing? You have no idea when this thing's going to get knocked down next to you. Dual commercial, you got to think about who you're going to sell into later on down the track. And so it was just it was nice to have that reinforcement. And then the second one was that one in Darlinghurst where it was that 3-beddy in an awesome location, but essentially needed a full knockdown. And you were like, take a builder, don't listen to the agent, because the agent was like, oh, all it's going to need is like $100,000 to put some new flooring and stuff in. We took a builder, and the builder's like, it's going to need about $600,000 to $700,000 in work. So we were like, can't afford that. So both instances you kind of called and just said you really need to think this one through, and thankfully we did.
Yeah. God.
Look, it is so emotional. Going through the process multiple times myself, I've got the knowledge, I know what to look for. But when you're in the market, you're at the mercy of the market. And I think people forget that. So you're only looking at what Domain, real estate have got online. And there's individual family pressure, right? That might be a kid coming. It might be a change of work. It might just be that you're getting exhausted and you're getting more tired looking at sort of buyer fatigue. And so what happens is you're constantly pressing refund. You're going and spending your Saturdays and going to open houses. And so naturally you get emotionally charged. And you've got family and friends who are talking to you about it. And you just want to kill the pain, right? And so what ends up happening is you start looking at what's on the market and you start to make it fit to your brief. And so what you originally thought you were going to go and buy, you can't find it. And then all of a sudden you start wandering off and you start exploring all these opportunities that just aren't great properties. So it's easy for us because we just look at it, bang, what's the address? Go on the satellite, look at the aspect, look at the neighbours. Look at any potential development around there. Look at who the property would suit. Look at any flaws. But for you as a buyer, you're just looking at the positives to get rid of your pain. And so I think that's why, we're also really big fans of buyer's agents. The ones that are very local expertise. They've been doing it 5-10 years. They've got a small team around them. They know all the agents. They know all the area because they allow you to calm down that emotional pull and actually think about things, get that independent third opinion. Particularly when you're going down the wrong path, they stop you buying the wrong property, I believe. So it's not buying the right property. Often the buyer's agent's role is actually slowing you down when you get too, trigger happy.
Yeah. Well, I think for me, that was one of the more valuable parts of working with you was my partner and I had a particular area that we wanted to live in, but we hadn't actually even been to any inspections yet. And you suggested a particular buyer's agent. Shout out to Frank Russo. Happy to put people in contact if they are interested, because we did one weekend of inspections. And you said it was only... You can only look at what's available on REA or Domain. What we learned is that there's a whole sub-industry that exists between buyers agents and real estate agents of unlisted properties before they go on REA or Domain. And Frank picked us up in his car Saturday morning, took us to like 15 open homes. Half of them were open and the other half were like unlisted, just with the agent. And he had our brief, and we found a place that ticked all of our boxes on that first Saturday. And so I'm sure that's not a common experience for buyers agents, but for us, I've got mates that have been looking for over a year and spending their Saturdays inspecting, and our experience was very different to that. But a buyer's agent wasn't something we had considered before we spoke to you. And we took a bit of convincing, I think. So, it was good.
Frank's one in the category of what I'll consider to be a great buyer's agent, right? Super experienced. He's an amazing negotiator. He wins agents over. He doesn't stuff around. He knows he's an ex-builder.
Yeah, so that was valuable.
That's I like about Frank.
Yeah.
And he's just got he's really able to figure out how to make a deal happen. There's a lot of buyers agents, they stuff it up, agents don't like them, etc. And so Frank's great in his pocket, right? But we don't refer to Frank all over Australia. But if you're buying around where you bought, Frank's perfect. He grew up in those locations. He knows those streets. He knows those properties. He's seen thousands of properties. And so he's very able to, and then he's also to say, well, this is actually really good value in this current market, because sometimes things move really fast. You've seen the property. There's good properties have competition. You actually want to buy a property that's hard to buy. That's one of my favorite sayings is it's hard to buy, easy to sell, versus easy to buy and hard to sell. Great properties are hard to buy, and they'll be easy to sell in any market. And so when you do find a good properties, it's going to be hard to buy. There's going to be competition, and you need to be able to make a quick decision on what it's worth, and suss out the vendor situation. And that's where I think a real buyer's agent's able you to strike fast if that's the right strategy. Sometimes it's not. Sometimes you have to let it go to auction. And Frank's really good to say, actually, this is only worth 1.2 because I've already gone and looked at all these properties and it's better than these and it's worse than these and this is a fair price, and can pitch it to the agent. And so I rate Frank very highly. He's one of the good ones.
Yeah.
Nice.
Well, Chris, look, we could keep speaking about our own experiences all day, but we put the call out on our Facebook discussion group that we were going to be speaking to you, and the number of questions we got back were pretty overwhelming. So we're not going to be able to get through them all. But before we get to those questions, we just wanted to, I guess, touch on the current property market and just get your thoughts on where things are at and perhaps where they're going. And then we'll get into questions from the audience. So let's start super general, the current market. What trends are you seeing at the moment? If you can particularly put a first home buyer's lens on it.
Look, if people haven't listened to me before, sometimes it's good to put a bit of extra context, right? So people naturally will go in and call, there's an Australian property market. There isn't an Australian property market, right? There's 11 million properties that are all owned by different people, and they all perform at different rates, right? And so what you've really got to do is cut it down and go, okay, then you can go to Australian, you can go to cities, you can go to inner ring and outer ring, houses, apartments, townhouses, bigger blocks, smaller blocks, 2-bed houses, 3-bed houses. So they're all doing different things, and they're all growing at different rates, and they've all got supply issues or listing problems, and some have got really strong demand. I would say that if you're looking at, first home buyers right now from a buyer side, first home buyers are really struggling. Because, 10 years ago when I started as a broker, we would say, hey, you can borrow 7 times your salary, 8 times your salary, sometimes more, right? And they'd go, no, I don't want to borrow that much. I don't want to borrow 1.5 million, right? Now when we go, you can borrow 4 or 4.5 times your salary. And they say, oh, that's not enough. I need more, right? And because borrowing capacity is really tight. So there's this real compression where first home buyers are stretching to their absolute limit, what they can borrow from a bank. And they're actually going and rattling the tin to their family, their friends, their aunties, their uncles, to find a deposit, because borrowing capacities have fallen 30% in the last couple of years, and prices have actually gone up. And so there's this compression on budgets. And so that's actually, it's an interesting dynamic at the moment. The bottom end of the market's actually outperforming the top end of the market. So the cheaper properties, because all the buyers are having to compete on these cheaper properties. And so there you're getting just too much demand, not enough listings, and those prices of properties are going up. And that's a real issue. There's a lot of intergenerational wealth happening. It's really a have or a have not. Some people are very fortunate, have grandparents and who can pass wealth over. And I think the people who haven't got that are really struggling right now, because there's also an issue where the market's absolutely getting driven by the medium and higher incomes. There's this real wealth inequality that's happening right now, is that because borrowing capacities are so tight, well, if your income's not that high, you can't borrow that much and you can't enter the market. And so you are getting a lot of talk in the market from the bank CEOs that they're going to have to start relaxing borrowing capacity because it's becoming a real issue. Look, there is an overall confidence there for first home buyers that regardless of high interest rates, there's a lot of rental crisis going on right now. And the veil's sort of been lifted there for first home buyers, because it was easy to rent right. There was always, you could just make it work. But in the last few years, a lot of people have been kicked out of properties. The rents have gone up 30, 40%. And that when you can't find somewhere to rent, your desire to get security increases. So a lot of first-home buyers are really trying to buy for security reasons, whereas before they were buying for wealth creation reasons. And so that's also supporting the market. Ultimately, a lot of first-home buyers still, there's a lot of research out there that a lot of Gen Z still believe that their best opportunity to build wealth is through property. And so all the reports will say that they still want to do that, but they're just finding it really difficult right now, depending on their incomes and their capacity.
What's your view on where things will go? You would expect that with the interest rate rises we've had, properties should crash. Well, not crash, but property prices should go down. But we've seen immigration, and I guess what's your longer term view?
What's really happening is there's a freezing up of the property market bit by bit, slowly every year. If you go back 10 years ago, like 2012, 2013, and look at amount of properties are on the market and how many people were changing hands of properties, it was a lot more than it is today. Probably 50, 60% more people were transacting, right? They were upgrading, they were selling, they were buying homes. And that's good because that's more listings, right? People have got more choice. But what's happening is every year, people are living in their houses longer and longer. We used to live in our houses for 7 years. Now we're doing it for 14 years. And so every year, listing numbers, which is actually supply, right?
Yeah.
There's 11 million properties, but how many can I buy today is actually getting tighter and tighter. And so even though people want to upgrade, they can't. They can't do the stamp duty. They can't do the jump in, debt. So in this market, what we've seen is under higher interest rate, people are less likely to move. And so in this high interest rate, this low borrowing capacity environment, listings have really frozen up. Now, as rates go down, that means the borrowing capacities go back up, but listings are really, really tight, and there's enough competition for the amount of properties on the market. And so whatever more borrowing capacity you give to buyers, they're going to go and spend it. Because they have to. And so as soon as rates start coming down, borrowing capacities will go back up because they're interlinked. And also people's appetite to borrow increases when rates come down because, mortgages are going to get cheaper. And so if we get into that environment where there's a lot more confidence in when interest rates are going, and that's flipping like a seesaw right now. We're recording this week. We recorded this 2 weeks ago. We would have said rates are going to stay high for longer. Then bad employment numbers over in the US, our inflation numbers were slightly under what we expected. Bang, yields fell. And now there's rate cuts could be coming in the next 3 months. And so a lot of that confidence will come back when the certainty around rates is there. I don't say that's now, but it is heading in the right direction that way. But when confidence comes back, it's almost like a 2019 scenario, I feel. And this is me trying to stay agnostic and independent to it rather than what's in my interest or our client's interest, right? I do feel like it's going to be like that where demand increases on low listings. And that's what happened in 2019. The market went on a bit of a run and it really surprised people. And I think that's what will potentially happen because people will bake that, even though they can't borrow that money, people will absolutely go, well, I'm happy to leverage up to my nth degree because I know prices are going to go up.
Scary.
Aussie property.
I know. It's a challenging, the even thinking about the next jump up. It's just to your point, I can understand why people are staying in their places for longer because you even the next level of debt that you have to take on, stamp duty, it's just like far out. It's huge commitment. Anyway, it is what it is. A question has come through from Sue on current market. She wants to know, how does inflation impact property, if at all?
It does invest in a lot of ways, right? If you think about it. So $1 million mortgage 5 years ago, is that really a $1 million mortgage today? Well, no, incomes have gone up, right? And so it really inflates debt away. And so the issue with inflation, though, is that to get inflation, you've got to get it back under control. So if it's just a little bit, it's okay. Interest rates are probably digestible. But what the issue with inflation right now is that the people who've got properties have got to service debt, right? And so inflation inflates debt away just as much as it increases the cost of living. So if you can ride out a higher inflation environment and support your mortgage, that's only going to make your mortgage less in the future, really, in real terms.
Yeah.
And so that's the first thing. Secondly, inflation is usually linked to wage growth. And wage growth leads to higher debt capacity. And so if you think about what people can borrow in, say, 3 years' time, when multiples of incomes go back up with rate cuts or APRA step in, a $130,000 salary is now gone to $160,000, and it's now 6 times multiple on that. And so, yeah, there is a bit of a short-term issue with inflation, but ultimately it does link into higher property prices. If you can get through that time when servicing debt's really hard. Yeah.
My 2 cents is inflation is great for existing mortgage holders and terrible for people who are trying to buy. Yeah.
Well, it is because it's ultimately just going to lead to high prices.
Yeah.
Yeah.
And like wages don't perfectly keep up with prices.
No, absolutely. And that's a lot of that comes down to that when people do transact in the market, it's not what everyone can afford. It's only a marginal buyer, right? And so you've got to really think, well, how are people affording that? And a lot of people, I hate all the articles where, the price of property is based on, and a median income. Well, that doesn't mean that a median income's actually buying in the market right now. And that doesn't mean they haven't got a 20% deposit, they haven't got a $1 million deposit, etc. And so you've just got to, there's so much wealth caught up in the property market that gets reinvested back in the property. When someone does well in a business, what do they do with those proceeds? They put it back into the property. So the property market's worth $11 trillion, but it's $2.5 trillion of debt. You know, just say circa those numbers. Like, shows how much equity's tied up and gets reinvested back in it.
Wow.
So, Chris, as we said, we've got so many questions here. We've kind of tried to structure them into before buying, and then what you're looking for when you're buying, not just first home buyers, but just generally. Then sort of like once people are in the process of paying off their mortgage, they've built a bit of equity, things they can do using equity. And then we've just got a heap of general questions as well. So let's start with when you're looking at different assets, you like Bryce and you're sending shitty ideas through to you. And
Which was super helpful.
You're striking them down. We had a couple of questions that I might link. First was, what are some common things people get wrong? And then secondly, what is a great, good, bad, and ugly asset? So, yeah.
Look, I'll start with the first one. So if you are a first home buyer right now, sometimes going for the hard option is actually the right option, right? So it's thinking through your life. Where do you want to live long term? Should you buy with your partner? Maybe it's only a fresh relationship. Are you going to have kids one day? Really trying to think through your longer term plan. A lot of first home buyers don't want to do that. I want to stay free. I just want to rent. Buy where I want to live right now. And the reality is in a few years' time, their life plan is going to change. And so think through your life plan first. Also, if you are finding it hard to buy, be persistent, right? Don't go down the easy option. A lot of first-home buyers, the mistakes they make is they go rush and buy some random investment property in some random location because they can just get a buyer's agent and they can just make it an easy decision. What they're doing is they're just putting off the hard decision. 3 years down the line, they're still with that partner. They want to have a family and they want to settle down. They've got some random investment property. Now they've got to sell that and they've got to get back into the market. And so I think that's the biggest mistake I think first home buyers make. Sometimes it's best not to buy, right? If you can't get a great asset and you've got a limited borrowing capacity because your income's still, only 60,000 because you're a cadet and in 2 years' time it's going to be 100, maybe you're best to wait, and get a better asset. And so there's a lot of pressure in society from family, friends that are buying, your parents to buy. And I think you sometimes got to say, look, it's not the right decision for me. So switch off that noise as well. And you can find hundreds of examples of where people have bought properties and haven't done well. Easiest way to look is core logic pain and gain report. And you can see in that report how amount of people who lose money on property. And a lot of those people are first-time buyers who have listened to their parents' advice just to buy anything because all properties go up. And so get educated first, which leads into probably your second question, to be honest. What's a good, bad, ugly property? This will probably take me about 15 minutes to answer, so I won't do that. But it does come down to demand and supply, And so if you always put it through that lens, I think it's a really good, way to protect yourself, right? And so if you think about supply first, it's really easy to think about supply. Are they going to build more of what I'm going to buy? Is it easy to build more of what I'm going to buy? And if the answer is yes to that, well, you've never got really limited supply, right? But if you've got a house that's easy to do and it's in an inner ring of a capital city, can they build more houses? No. Right, so it's got limited supply. It's actually got shrinking supply because every year they're knocking houses down to build townhouses, to build apartments, to build roads, etc. If you're buying a new townhouse, can they build more townhouses? Well, yeah, they can. They can just keep knocking houses down and build new ones. And so if you're buying a house and land package, can they build more of those? Can they build more high-density apartments? So be really careful buying anything where you've got no limits on supply. And then from a demand point of view, it's not what you want. The property is priced based on what the market, how many people want it, And if your property only suits a very small buyer pool, then when you sell it one day, you've got to hope that buyer pool is really strong. But if your property suits lots of different buyer pools, singles, couples with one child, couples with two kids, couples with young kids, couples with older kids, downsizers, divorcees, multi-generational families, etc., and investors, then you can see that your demand's much stronger. And so just be really careful buying a property that's really boutique. It only suits a certain buyer pool, and there's no limits on supply. Once you've got those things sorted, this doesn't mean that's maybe 80% of the heavy lifting, and then it's all the 1%ers. Is it on a good, quiet street? Has it got good aspect? Is there any issues with privacy? Any issues with noise or smell? Is it in the nicer part of the suburb, or is there in more the rougher part where people don't really want to be, where it's a bit can't get to the local amenity? It goes on and on and on. Is it a rat run? Those things all add up, because once you're in a suburb, you'll naturally see that there's two parts. There's the quiet streets that everyone really wants to be in, and then there's the part that's got a really busy road that no one really wants to live. And those properties keep turning over, because new buyers in the suburb will buy in those because they're a little bit cheaper. It's their way to get in. And then 3 years later, they say, I can't stand living here. That negative is really annoying me. And then they sell. And so there's usually always, and particularly in down markets, there's usually always an oversupply of these type of properties and an undersupply of the good properties. And when markets get really hot, the good parts of the suburb, the better, quieter streets, go for premium prices because people really leverage up. And so just be really careful. You do need to be really strategic, and some properties are deal breakers. They're just duds. And, you can potentially overpay for them in hot markets. And if you have to sell in down markets, you can get really, really stung.
That was everything you mentioned there was a process that we went through when we were looking, and learnt from you as we went, and we ended up having a bit of a checklist as we would go and look at properties, like aspect, neighbours, area, all of those sorts of things that you can even then start excluding going to the inspection and wasting your time, because you can see the floor plan, which way it's facing, apartments next door.
Do you still have the checklist?
Yeah, we've still got it. It'll be in an Excel somewhere.
Yeah, if you join the Facebook discussion group, Bryce will share it in there.
Nice, and then you can send it straight through to Chris.
Let's check the checklist.
Yeah.
And naturally, I think we forwent some of the points on there, but broadly, when we bought, we definitely got more than we thought we would when we started out. So I think that's actually a really good point, because sometimes to achieve that and all, no compromises. Yeah.
It's never on the market. Yeah. And B, the cost of that would probably be, too expensive, right? Yeah. So it doesn't mean you can only buy perfect properties. That's a misconception, right? But what you really want to do is know the compromises you're making, and is that factored into its price? And am I really going in eyes wide open? And am I knowing that when I sell this one day, that's going to be the things that hold it back. And it's going to hold its growth back. And the more compromise the property has, that means it's easier to buy, right? But it's going to be harder to sell it one day. And if you do buy a property that's got lots of issues, you really lose the ability to sell it easily. And when the market's average, you've got to ride that wave. And so your ability to just transact and go, oh, okay, we're going to buy this property, and if we don't like living here, we're going to go and sell and move somewhere else. Well, you might not have that ability to do so.
Now, Chris, we're going to keep it moving because there's a lot of questions. Moving to the using equity once people have started paying off their mortgage, I think one of the more common questions we get these days is around debt recycling.
Yeah, so many.
So this question came in from Bryce. This is you?
Yeah, well, I had this, and then I reckon we've had 10. I haven't even put all of them in the doc that are specifically around debt recycling.
So, and specifically here, if someone wants to set up debt recycling without an advisor, is that something that you would suggest doing? And can they do it directly with a mortgage broker or with their bank? How do they do it?
Yeah, absolutely. I mean, you can definitely do it without an advisor. It's interesting. So I was an advisor for a long time, right? And so this is it's something I know very well. It's something, but you do need to be going into it eyes wide open and really understanding what you're doing, right? I actually don't like the word debt recycling.
Okay.
Because if you think what recycling is, it means that you buy something and then you sell it to pay off debt to then get more debt. That's where the recycling element comes in. Like, ultimately, when you buy good assets, you shouldn't really sell them. Okay, so what it fundamentally is someone's got usually a residential property. It could be done on commercial, etc. They go to a bank. The bank values the property, just around numbers, $1 million, right? And then they look at your loan, and your loan $600,000. Okay, you as a think I've got 400 grand of equity. Well, no, a bank doesn't look at it that way. They say, well, let's value your property. Okay, you said it was worth $1 million. Actually, it's not worth $1 million. It's worth $950. Bank values usually come in a little bit lower, right? It's not in the interest of the bank to do too high. And all banks do different valuations. And so often when people are doing this strategy, we have to do 3 or 4 different valuations, because you might get a low one, you might get one super high, and sometimes you'll go with the high one, right? So let's say it values at 950, 80% on 950, 760. You had a loan of 600. Okay, well, we can release 160 grand from your loan, from the bank, and it will go into a separate loan, a separate split. It won't be your loan won't go from 600 to 760. You'll have a 600 grand loan, and you'll have a $160,000 loan. When that money's released, it'll go into an offset account. Now, you won't pay any interest. Technically, that loan should be interest only as well, so you're not paying it off. And so you have your $160,000 loan with $160,000 in the offset account. Now, usually when you're investing in markets, it's pretty brave to go and put 160 grand straight in the markets, right? And it can work at times, but it also is very emotional to do so, right? So a lot of people will dollar cost average into the market, right? And drip feed it in. And so you might put in 5-10 grand a month, right, for a couple of years. What the issue with debt recycling, in my view, is that once you then, what the plan with debt recycling is once those assets go up over 160, right, is you'll take that profit and pay off your 600 grand home loan. That'll release more equity, and then you'll buy some more shares. I think that, you pay your 600 grand loan down with your savings and your income, but you hold on to those shares and and buy long-term investments, right? And you release more equity, but you release more equity because your house price has gone up and because you've paid your home loan down, not because you paid your investment loan down. And so I think it's the issue I've got with it is that people are trying to do short-term investing, selling it off, paying capital gains tax to pay off their home, then to reborrow and buy shares again. I just don't think it's worth it. Yeah. But you do just need to be careful. I just think you need to have a long-term mindset. You need to know what you're doing, what you're going to invest in, and really understand how the cash flow works, because you're going to pay interest on that 160, right? But you're also going to get some income from whatever asset you buy, and you can claim that in your tax return, but you still need to afford the interest up front, and you might not get your dividends, or you might reinvest your dividends, right? And so just really understand your cash flow before you go into it and what you're buying.
Now, I would say Bryce may have asked this question as wanting to set up debt recycling without a financial advisor, but I also think that if that conversation was confusing, you should certainly think about seeking professional advice, because
to be fair, I'll probably seek professional advice.
you don't want to screw it up, especially if it's like your primary place of residence and
Yeah, it's not as bad as like a margin loan, right? Where if you do buy something and it goes down in the short term, then you have to put more money in and you can really get yourself like a margin call. So that is a 30-year loan. And so as long as you can keep paying your interest, if the value of what you buy does fall in value, That's why you've got to have a real long-term mindset with it, right? And so just be really careful what you buy, and don't go and buy some crypto or something.
No. Well, Chris, we're going to take a very quick break, and then on the other side, we're going to whip through just a bunch of general questions that have come through. So we'll be right back. Welcome back to Equity Mates. We are here with Chris Bates, co-founder and mortgage broker at Flint. We should also let you know that in a couple of weeks' time, we're going to be going live on YouTube with Chris for our first property webinar. Very similar format to this because we've been inundated with questions. So a Q&A on YouTube. It will also obviously be available. If you can't join us for that lunchtime session, you can watch it on demand on our channel. We'll put information on that in our daily newsletter and on our socials once we have the links available.
Now, Chris, we've spoken to Sam Gordon on the podcast a couple of times, who's a big advocate of rentvesting. So I want to get your thoughts on it for people who are thinking about that as a way of potentially taking their first step in the property market.
All right, nothing against Sam. So if you're listening, Sam, look, I like to stay a bit agnostic, right? So rentvesting makes sense for some people. Yep. It makes sense for sometimes in the market. And other times it doesn't make sense, right? So rentvesting made a lot of sense back in 2014. And the reason is back then, interest rates were a little bit high, or not high as in compared to current standards. Interest rates were a bit higher. Borrowing capacities for investments were much higher. You could borrow astronomical amounts of money versus your income, 10, 12, 14 times. If you knew how to, because banks had lots of flaws in the way they did calculators back then, right? So you could buy a home 6 or 7 times your salary. You could buy 10, 12, 14 times. You could leverage up a lot further into investment properties. Plus homes were a lot cheaper, right? And so the pressure to own wasn't really there. Interest rates were higher, so owning homes is more expensive. And you could tax deduction all your investment properties on negative gearing, right? And you could get interest only really easy. That was a perfect time to be doing rentvesting. Things have flipped completely, right? You can basically borrow the same when you're buying investments or homes, right? If you go back to 2021, you can't say rentvesting was a great strategy because what actually went up a lot in that period was homes, right? And the capital cities. And interest rates were really cheap. And so that's when you actually better to buy homes, which were growing tax-free, versus buying investment properties, which were not much negative gearing benefit there. You couldn't buy many more of them. So at the moment, rentvesting is a good option for people who can't afford to get into homes, who just want to go and buy and can't afford to buy where they want to live, and they just want to buy some investment properties. But you do need to structure your loans really well. You need to get your interest only there. You do need to know that you're probably looking for short-term returns because a lot of rentvestors really haven't solved their owner-occupier situation. And what we see is time and time again, people go out and build an investment portfolio, then they get a partner, then they are living in a capital city because they, want to have their incomes tied to the capital city. Then they want to have a family. And then the only way to enter that market is to sell all their investment properties. And so you've got to be really strategic, knowing that you're likely not to keep all these properties. You are looking for short-term growth. And when you're looking for short-term growth in property markets, the risk goes up. There's a cost to buy, there's a cost to sell, there's capital gains tax, there's holding costs, etc. And markets go in different directions, etc. So just be really careful when you are doing that strategy. You've got to go in and go, well, I am doing this, but I haven't solved my lifestyle need. And that's fine because a lot of first-home buyers think, I'm happy to rent forever. But what happens as soon as you get a partner and a kid's coming along, your desire for security goes through the roof.
Yeah.
Not just your partner's needs, but you as the other side as well, because you've got school zones, you've got communities, you don't want to move around, you've been kicked out once or twice, and then you just really want to own. And so just be aware of those challenges.
School zones, something I haven't even thought about. Anyway, so this one's come through from Nicole. What's your thoughts on purchasing a block of land and then subdividing? Good strategy. What should they be looking for? Who should they be engaging? What should they be thinking about?
Look, absolutely. It's not all blocks are great to subdivide. And some blocks are way better than others. And so just be really careful when you do that to get a really good block. Obviously, do it in an area where it's not likely that everyone else is going to subdivide. So if you can find a good block in an area where land's really tight and land's really valuable and really scarce, and then you can potentially make some good money in it. If you buy a block to subdivide and every block in the area can be subdivided, then likely you're not the only one thinking that strategy. And so I think that's where the money's made, is that you buy a property that a lot of people don't think you should subdivide, and then they figure out actually you can subdivide it. And so it can absolutely work. Look, then if you did, because what you're doing is you're saying, well, to buy a block of land to live in for a house might be say 1.5, but because I've subdivided, you can buy a block of land for a house for $1 million. And there's enough demand for that because there's just no blocks of land for $1 million. So I think you make your money there when you take your time to buy that piece of land. And sometimes you buy blocks of land, you go, I can subdivide it, but actually there's an easement through it, or actually it won't work with a driveway and I can't get it through council, and there's an environmental challenge and the neighbours. And usually they're the best blocks of land to subdivide, are the hardest ones to subdivide. That's where you make the most money. And so that whole thing, I'm just going to buy blocks of land, subdivide them and make all this monster of money. Well, if it's easy to do it, then there's not much money to be made.
That seems to be a recurring theme in a lot of the aspects of this conversation. You do the hard things early, and it generally is where you make more money, or it's better long term. Harder to buy, easier to sell. You were saying earlier, harder to subdivide, more money to be made. So just do the hard things early is really what I'm walking away from this conversation with.
And I've had clients who've done it ridiculously well out of it, right? Like I can think of one up in North Shore. He had a huge block and he fought for it for years and he made a mozza out of it, right? It's the same as getting rezoning, changing, or buying a block of land that, it's only got 6 apartments and you've held on because you knew that zoning would change, or you knew you'd be able to get something approved. When that zoning changes and you can go from 6 to 20, and a developer wants it because it's in a great location, you make it. So, you've just got to... Not everyone's making money on buying blocks of land near train stations, right? They think they are, right? But it's when a developer wants to buy it and is there a scarcity? Well, no, there's not. There's heaps of blocks around the train station.
Yeah. So, Chris, we are almost out of time, but just a reminder that if people want to ask their questions, they want to hear Chris again, we're going to do a webinar with Chris. We're looking at the 29th of August. So you can watch us live then, or it's on YouTube, so it'll be on demand. But we've got one more question as we wrap up. This is from Stephen. He's got a first property and now he wants to upsize because he's part of a growing family. So I'm sure a very common scenario that you see. He's asking, what's the difference in terms of borrowing powers, and how should he think about more generally the choice between selling that first property or renting it out and trying to buy the second one?
Stephen, even if you want to keep it, you might find it hard. Just borrowing capacity is really tight, right? So, a lot of people are in this situation. There's this whole view that, buy property, never sell, right? It's come from generations before. And that's great. Yeah, if we could all had unlimited borrowing capacity and limited cash flow, we would just hold everything, right? But it's just not the reality. So Stephen just probably needs to think through, has that property done its purpose? Have I built my equity from what I went in? Before I bought that property, I had 100. Now I've got 500 grand. Because I bought a good asset, I added some value to it. Yeah, it's a good asset, but I've got what I needed to out of that property. I've built my asset base. And I'm going to maybe one day wish I could keep it. But if I can sell that, have enough cash to then go and buy a family home, and then that's another good asset, then the only way for me to get that growth or, live the life with my family was to sell it. And so sometimes you just got to... Even though it's hard, you just got to go, well, I've got what I need out of that property. I would love to keep it, but I can't afford to keep it from a cash flow point of view. If Steve is in a really strong income position, it depends on how the loan's structured. Sometimes people stuff it up on the first property. They structure it the wrong way. Another, legacy sort of myth out there that, you've got to pay your debt off as fast as you can. It's true, but pay it off via an offset account, not by paying your loan down. So what Stephen might have done is he might have bought an apartment, had a loan of 500 grand, and then was on a good income and smashed that loan down. Now it's got 100 grand of debt owing on it. It's worth 800,000, right? That debt's structured the wrong way. It's got very low debt on it, and it's got a lot of equity in it. So if he tries to upgrade his home, he's going to have a huge non-deductible debt on his home. And so a lot of people who have paid off their first home have to sell it because they've just paid it off. And whereas if he kept that loan really high, it allows him to have a lower non-deductible debt on his home. And so, look, what he really needs to do is figure out, what can I borrow with keeping it? What can I borrow without keeping it? And then think through, what's the best way to strategically upgrade? Do I buy first on a longer settlement? Do I try to sell first? It really depends on the asset quality. There's a lot in that upgrader. There's also then bridging and stuff like that, which only a few people can sort of be eligible for.
What's bridging?
Bridging. It's more when people they need short-term finance between the purchase of one property and another, usually when they buy before they sell, and there's a gap where they need a lender just to lend to them to cover that gap.
Bridging loan.
And there's two types of bridging. There's bridging through big banks and there's bridging through private lenders. Bridging through big banks is really conservative, so you have to be in a really strong position. Private lenders usually sting you with a good application fee, and a higher interest rate generally.
Well, a lot of things in there that I think would benefit from speaking to you and the team or a professional. So a reminder that if you want to be put in touch with Chris and the team, head to equitymates.com/advice. Ren and I certainly got a whole bunch of value from you through our journey. This is the first of many episodes that we'll be doing with you, Chris, over the coming 12 months. So we're super pumped about that because there are a lot of people in the Equity Mates community who are on the journey of either owning the home and thinking about the upgrade or still in that first home buyer mindset and trying to find their entry point.
Just thinking about, people going to our website and getting put in touch with you, Chris, is there a certain time before people buy where they should start engaging with you or a mortgage broker more generally?
No, we don't have that mentality. So we've got, initially what you would do with our team is you would talk to our client experience team. We've got 3 girls in that team, Ali, Kathleen and Sandy, and they'll just get to know your situation, what your plans are. We can guide you through if there's any risks with you borrowing money, give you some rough numbers, help you think through if you've got a complex situation. We can get those numbers to you. So definitely, even if you're really thinking about it, because sometimes things take time, and we'd rather you to start putting some work in than coming a year later and go, I'm ready.
Yeah.
Actually, no, you're not. It could be issues with a credit file. It could just be a savings issue. There's lots of things.
Even things like going and finding out what your number is and then figuring out that if you paid off your HEX debt, your borrowing power goes up. Or if you shut your credit cards, your borrowing power goes up.
Absolutely.
To speak to my experience, I had a surprise with something that I didn't realize was an issue on my credit file. I said earlier we only had to do 1 weekend of inspections, but actually getting the loan sorted was the thing that took time. So it pays literally sometimes to engage early. So equitymates.com/advice. We'll put you in touch with Chris and the team and go from there.
Absolutely.
Nice. Well, Chris, thank you so much. As I said, plenty more to come. So we really appreciate your time.
Yeah, I'm pumped for the webinar. I love them because it's just, you get 5 questions. You never know what's going to come. And very excited for that and future episodes, and loved helping you both and your families. So thanks so much.
Thank you.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.